Okay, we have a request from Godel, so I have to prioritize that. Make sure you sign up for Godel. The guy wants Avago, which I've never looked at. This used to be called Broadcom. Okay, so this is maybe how you would look at a stock from scratch. So this might be helpful to some of you newcomers. I like to look at the what's called the capital structure first, or the kind of 6 most important things I look at in any stock. The first is the stock price, which is pretty simple. This is the last sale of the stock in any given market. In this case, it's $156. It's unimportant to get it exactly right. It doesn't really matter that much what the pennies are. Now I'm looking for shares outstanding, and you can see that the last 10Q, there are 463 million shares outstanding. And then if you multiply those two numbers, you get a market cap, and that's 72 billion here. I thought Broadcom was a bigger company. Maybe they did a split or something. We'll have to see, and we'll just that'll be discovered as we go through this. They do a 10-for-1 or something like that. This is March 1st, so we'll just check the news out and see if they did a stock split. Okay, here's the balance sheet. I just like to take the cash, which is 11 billion in this case. And then I'd like to take the debt, which is 73 billion in this case. And the enterprise value is basically the value of the company net its cash position. So in this case, the value of the company is higher than its market cap because the company is a net debt position. But again, I want to check right now about that stock split, because that's unnerving me a little bit. So I'm just Googling investor relations, news releases, and you can find this in Godel as well. 10-for-1 forward split on 7/15, so that was 2 weeks ago. So if you split your shares 10-for-1, you have 10 times as many shares. So this is a market cap of 722 billion, one of the biggest companies in the world. Just to think about how big $700 billion is. It's about as big as Berkshire Hathaway, Warren Buffett's company. It's bigger than every football team, baseball team, and NFL team combined by far, still times 10. It's bigger than almost every country's GDP. Not every country, but quite a number of countries. If you asked me back in my day, if there'd be $1 trillion company, I'd say maybe. And then if you told me there'd be a whole bunch of them, and even if I'm not streaming, I'm happy to do some requests for you if you subscribe to Godel, which is part of my new software company. Yeah, we can go through this a little bit more slowly. That'd be my pleasure. And I have a number of videos. They're not necessarily on my channel, but you should be able to find some of the old videos I did on financial analysis. So I'm going to start with the income statement. In some ways, for most tech companies, it's a bit more important than the balance sheet. The balance sheet's important too, don't get me wrong, but they're both important. So I'm going to put the dates down here as well as the calendar, because this is a company that has a different calendar quarter from their fiscal quarter. So if you ever get confused in calendar and fiscal, and even the big brained of us do, just look at the dates, and those are the 90 days ending those dates. So you don't have to break your brain too much. And if you line them up together, as I'm about to, it gets a lot easier. So for example, they call this quarter the second quarter for the fiscal year 2024. So I do fiscal Q2 24. And by the way, if you follow these videos, it turns out that most of Wall Street has adopted the Shkreli method, which is kind of crazy. I'm very flattered by that. Revenue is the products that you sell. In some countries, that's called turnover. It's either revenue, sales, or turnover. Sometimes also called top line. So that's just product that goes out your door. The only interesting thing about revenue is when do you recognize your revenue? Revenue recognition is a tricky question. Usually you recognize revenue when title passes. You do not recognize revenue. The normie will often think that you recognize revenue when you get paid. No, never, ever, ever, ever. That's a rookie mistake. You recognize revenue when title has passed to the customer and the customer owes you money. Whether they paid or not is not that important. So you can see Broadcom grew pretty dramatically. I think that was due to an acquisition. I think they bought VMware, if I'm not mistaken. They got a little bit more into software. And just off the bat, I can do this really interesting calculation, which is new divided by old minus 1. And that's 43% growth. Year. All right, so 43% revenue growth must have came from an acquisition. And I will call up your mom and flirt with her and copulate. Don't test me. You think Shkreli doesn't know how to be entertaining? I taught all these guys how to troll, bro. I taught them how to troll. Cost of revenue is often called cost of goods sold. It's the same thing. And gross profit is revenue less COGS. So you have revenue, and you take away or subtract cost of goods sold. Somebody's asking about efficient market hypothesis. I think markets are mostly efficient. But if they were really efficient, there wouldn't be any good investors, and there seem to be some good investors out there. And also, studying financial statements gives you a great insight into business in general. So you don't even have to be trading or investing. You can just be studying an industry. And you have to know this stuff if you want to know the industry. Hopefully that helps. All right. Gross margin is 75%. So that means that for every dollar of stuff Broadcom sells, 75% of it is what they keep after they subtract what it costs to make the stuff. Similarly, if you had a lemonade stand and it had $100 of revenue, the cost of goods are your lemons, your water, your sugar, your cup, the salary you pay for the person to stir it. That counts as cost of goods. And if that costs $25 and you had $75 after you subtract those costs, you have $75 in gross margin. Gross profit is not the same as net income. Very, 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 very different. Gross profit is just profit after the cost of the materials that it costs to make the stuff of the company. Now we have research and development. It's a little self-explanatory, but this is basically product development. In pharma, you do R&D, like including basic discoveries. But in tech, it's often called product development because you're doing research and development, but you're really just making new products. So that's trying things out in the arena. SG&A is a little more even understandable. This is all your selling and marketing costs, your general administrative costs like auditors and lawyers and management team members and tax people and you name it. All that stuff goes into there. So it's kind of a catch-all. So together, these things form what we call operating expenses or OPEX. Operating expenses are like the cost to operate the company, not the cost of materials. The cost of materials is over here. So if you zoom in real close, this is a good basic business lesson. These three things are the cost of the company. You sold $12.5 billion of goods, but this could be 12.5 million or 12.5 thousand for your small business. It doesn't matter how much money we're dealing with. I'm just going to put dollars and millions over here so we know. But you sold $12.5 billion of product. It cost you $3 billion to make the stuff, $2 billion to research the stuff, and $1 billion to sell the stuff. How much do you have left over? $5.65 billion. That's called operating income. So that's what your business brought in on a business basis. We're going to look at some other subtractions in a second. So there's a couple different ways to look at it. Here is the profit excluding materials costs. Here is the profit excluding materials costs and business costs. And we look at these ratios quite often. For example, operating margin, as you can imagine, is the operating income divided by revenue. And the operating margin is 45%, which is very high. And it's fun to compare that to other businesses. So you could say, okay, the operating margin of Ford is 5%. Why is it so low? Well, it's a tough business. It's a harder business. It's not as profitable. let's look at some other lines. So now interest expense, Broadcom borrowed a lot of money to buy another company. So they have to pay interest. That makes sense, doesn't it? They also made some interest, which is very small. And in essence, we have a new line called pre-tax income. I could do a pre-tax margin down here, but I won't bother. Operating income is sometimes also called EBITDA. If you're really about the Wall Street life, you name your dog EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. Operating income and EBITDA are slightly different, but we won't get to that just yet. So now we have taxes. Here, Broadcom paid negative taxes, which I'm sure is going to make Bernie Sanders really mad. But in reality, they probably did pay taxes. It's just GAAP accounting. GAAP is generally accepted accounting principles. And when they say generally accepted, they mean you better accept it or you're going to the big house like Shkreli. It's not a suggestion. The generally accepted. It's like generally, sometimes yes, sometimes no. This is it. You got to accept it. But GAAP often distorts real net income. So sometimes you have to adjust it, and that's called non-GAAP. And there's nothing wrong with non-GAAP. It just doesn't conform to the standard. So there's 480 million shares outstanding. This has gone up 10x, as we know. And so the company made $1 a share in earnings. What does that mean? After all their costs, including their negative tax, they made $4.8 billion. Well, there's 4.8 billion shares, so it's roughly $1 a share. I'm going to go update this as well. And now let's do the quarter before. So the quarter before, and I can actually copy and paste all this because the formula is pasted over. And so I can just plug and chug. It's what we call plugging and chugging on Wall Street. You ain't stay up late into the night plugging and chugging, then you ain't like me. You make 6 models a day for 6 summers. Shout out to anybody who knows the reference. And you can see the trends over time for how margin moves around. You can combine them, Alex, or you can separate them. 3 beats a day, right? Okay, so we have some more information here. Again, 43% revenue growth, but I think that's all from an acquisition. So if you borrow to buy another company, are you really growing 43%? Your base business probably is not growing 43%. And next quarter, your growth will probably drop because eventually you annualize or anniversary the acquisition, right? So if they were doing around 7-8 billion before, they bought a business that leaped them to 11-12 billion. That growth is kind of artificial. So we sometimes say the word inorganic. If they never did an acquisition and they were growing that fast, that'd be incredible. Very few companies can grow that fast at that size. NVIDIA can. Now let's look at the balance sheet. So cash, I just want to give you the link if you want to follow along. Cash is 9809. AR is accounts receivable, so that's money your customers owe you. Inventory is next. The balance sheet is listed in order of liquidity. Liquidity is how fast will it turn into cash. Other current assets is a bunch of stuff. PP&E is property, plant, and equipment. I actually thought Broadcom had more PP&E. Guess not. Goodwill and intangibles are a weird GAAP accounting thing. They don't really mean anything. And other long-term assets. So those are the assets of the company. And they sum to 175 billion. Now let's look at the liabilities of the company. Accounts payable, it's money they owe vendors. Compensation, money they owe or they are obligated to pay, more likely, their employees. Debt, we have short-term and long-term debt. Short-term is due in a year. Long-term is due more than a year. There's that. Other current liabilities and other long-term liabilities. Again, current means 1 year. Long-term means more than a year. shareholder equity. I kind of gloss over that. It's kind of a complicated idea. But ultimately, the balance sheet has to balance. Liabilities plus shareholder equity have to equal assets. That's the fundamental equation of finance. There's like, fundamental equations in different fields of study. Well, that's the fundamental equation. So goodwill is might as well zero it out. And some people do that. They call that tangible book. But it doesn't really make a difference. What matters is the cash flow of the company. And we're going to look at that in a second. So cash flow is very complicated. There's two ways to look at a company's operations, through the GAAP lens and then through the cash lens. A lot of old school people like to look at the cash lens only. I think you have to look at both. So the company made $4.8 billion according to GAAP. But watch what happens. Watch this crazy trick. We're going to, so according to their public statements, they made 2.1. That's listed here. This is GAAP net income, 2121. But we made a bunch of adjustments and we got to 4.8. So here's the adjustments they're making. They're going to get rid of amortization, which is writing off goodwill, basically. They're going to get rid of depreciation, which is writing off capital equipment, and they're going to get rid of stock-based compensation. That stock-based compensation one's a little bit confusing because that is a real expense in some ways. They have to get rid of the deferred taxes they have, non-cash interest, and some other stuff, and then working capital changes. So when you get rid of all this stuff and you basically just say, how much cash did we make last quarter? And you add it all up. What's amazing is it was 4.6 billion, but they said it was 2.1 billion. So if somebody came to you and said, hey, you're the heir of Broadcom, you just inherited Broadcom, congratulations, you're the richest person in the world. Basically, the CFO would come to you and say, how much money did we make last quarter? He would say 2 billion. So how much money did we make last quarter? And he'd say 4.6 billion. And you'd say, how could you tell me two different answers? And he'd say, well, one is from the cash flow perspective and one is from the GAAP perspective. And you might say, this is really confusing. I'm going to go back to being a Nepo baby. So it's important to understand those differences. It's not easy. It's not rocket science either, but you can do it. If I can do it, you can do it. Okay, so that's really it for financial statements. To understand Broadcom, we have to look at more than just the financial statements. For example, they're rumored to potentially be making a chip for OpenAI. Interesting, right? I like how they do their financial statements, by the way. And I know nothing about Broadcom, so we're going to spend some time learning about Broadcom. Ah, I see. This is where the acquisition must have happened. Do you see that big jump in revenue? Amazing how profitable they were. You also see the big jump in interest expense and a jump in shares outstanding. And you can see how easy it is to sort of fill these things out once you've already set up the framework. It doesn't take but a minute. And you have that model for life. So you can share them, upload them like I have on the GitHub. And again, it's more important. The reason we do this is because the companies don't provide these numbers longitudinally. They only provide them for each quarter. So it's a little frustrating. So on Wall Street, this is how everybody does it. When you're a fundamental analyst, at least, and you're not a quantitative investor. Quants have kind of beaten the pants off the rest of us. Using a computer to invest is working really well for some firms. And it has been for a long time. Let's look at this quarter's difference between cash flow and net income. And we just check to make sure our numbers match, and they do. So again, big gap between, no pun intended, between net income and cash flow. Okay. So that was all the news for 2024. Let's look at 2023. And you can see they acquired VMware, which is a software company, virtualization software, 11/22/23. Virtual machines, that's the VM in VMware. That was a big acquisition. VMware was one of the biggest software companies in the world. And for Broadcom to buy them made them kind of an unusual company, both hardware and software. And we're just going to do one more quarter, and then we're going to look at what they actually do. It's interesting how like the VMware acquisition didn't seem to make them more profitable. If you notice, their operating margin just dropped, and they weren't growing before the VMware deal. All right, well, we could take a step back and just see what in the world it is that this company does, which is probably more important than even the financials at this stage. So I'd start with the 10K. The 10Q is useful too, but the 10K goes into like extreme detail on these matters. Semiconductor and infrastructure software. I guess they had Symantec. They were Symantec at some point. That was a big software company. Obviously VMware, Broadcom. I didn't know they were LSI as well. And I don't know what they bought from AT&T. These all used to be publicly traded companies. So this is like a conglomerate of all these old companies. So they make CMOS, which is complementary metal oxide semiconductor. And analog 3 to 5, which I don't even know what that is, but we'll learn, right? That's the whole point. Set-top boxes. Set-top boxes are kind of gone, huh? A lot of different stuff. Fiber channel storage area networking. VMware deal, $30.8 billion in cash, so total $86 billion. So 38 in cash and like 50 in stock, Broadcom stock. Huge acquisition. Probably one of the biggest acquisitions in the history of technology. Are made by imprinting a network of electronic components onto a wafer. They're based on silicon wafers. Their products are silicon wafers with CMOS transistors. Third to fifth elements. So this is like germanium and stuff like that. Let's look if they break down their revenue by different segments. That's always an interesting way to do it. Looks like they do custom ASICs too. But RF. 20,000 employees on 1029. Amazing. 𝗥𝗚𝗃, CEO, 𝗥𝗚𝗃. All right, so here's the annual section. We're going to do it like this. And this would just sum to the number we see here, which it does. They also break down revenue between products and subscription, which is cool. Or products and subscription and services. So that's really helpful. So they have one big distributor, WT Microelectronics. Never heard of them, but this isn't my space. Sorry. Oh, they do the Malaysia trick. They sell in Malaysia, and then the Chinese companies bring them back to China to avoid the tariffs. It's a little trick, you know? Okay, it doesn't look like they break revenue down any further than that, which is frustrating. Looks like we got one more year annuals here. Again, it's hard to determine how much of this growth is by acquisition. Look at the cash flow, though. It's pretty substantial cash flow. I'm just going to hard code these numbers in for now. Well, I guess I could sum them through this one, right? Oh, no, I can't. Let's see, 13, 764, 16736, 18085. Oops. So what do you think it'd be for this year? Maybe 22 billion, so 40 times. I don't know, it seems expensive to me, man. It's like a generic tech, it's like almost like a tech mutual fund. You know what I mean? Like it's just a tech conglomerate. It'll probably keep going up, but it's not a bargain. And it's a roll-up, right? All they do is borrow money, buy a company, borrow money, buy a company, borrow money, buy a company. Nothing wrong with that, I do it too, but one mistake is all it takes.